Understanding a company's value is crucial for investors. One method commonly used is relative valuation, a form of business valuation that compares a company's value to similar entities. Let's dive into the relative valuation model and explore its applications and types. Imagine you're an investor trying to determine a company's worth. Relative valuation comes into play when comparing a company's stock price to others in the same industry or sector. It's a quick and effective method, especially when dealing with similar entities. The three most common types of relative valuations are price to earnings, PE, enterprise valuation, EV, and price to sales, PS. Each ratio provides a different perspective on a company's valuation. PE ratios compare a stock's price to its earnings. A high PE ratio suggests investors are paying more for each dollar of earnings, while a low ratio indicates a potentially undervalued stock. EV ratios compare a company's market value to its underlying assets and earnings. A high EV ratio may signal overvaluation, while a low ratio could indicate undervaluation. PS ratios compare a stock's price to its sales. A high PS ratio means investors are paying more for each dollar of sales, while a low ratio may suggest a better valuation. Despite their usefulness, relative valuations have limitations. They should not be the sole basis for investment decisions. Fundamental factors should also be considered. Among all, the price-earnings ratio, PE, is widely used. But what does the PE ratio indicate, and how does it enhance our investment decisions? Applying the PE ratio, if a stock is considered undervalued, it suggests the market price is relatively low compared to its earnings. Conversely, an overvalued stock indicates a higher market price relative to earnings, possibly driven by optimistic expectations. It is important for investors to note that whether a company is undervalued or overvalued is determined by comparing the company's relative value ratios to those of its peers or the industry average. In conclusion, a relative valuation model helps investors estimate a company's value compared to similar entities. It provides a rough idea for investors to make informed decisions when considering stock investment. However, it is crucial to recognize that relative valuations should be complemented by a thorough analysis of fundamentals, market conditions, and other key metrics.